stop what you're doing. Don't scroll, don't click away, because what I'm about to tell you is not market news. It's not another headline designed to scare you for a few minutes and then fade into the noise. This is a moment in history where the financial world splits into two timelines, the people who saw it coming and the people who didn't. Today is Tuesday, January 20th, 2026, and at 11:43 a.m. Eastern Time, just hours ago, one signature was placed on one page, and that signature struck a match inside a room filled with gasoline, the kind of event that doesn't look dramatic on television, but reshapes the future underneath it. While cameras focused on ceremony and speeches, something else happened in plain sight, something the mainstream tried to minimize, cut away from, bury beneath softer stories and distractions. But markets don't care about optics. Markets only care about consequence. And the consequence of what happened this morning is already moving like a shockwave across the planet. At 11:43 a.m., President Donald Trump signed Executive Order 14107, officially titled the Strategic Monetary Metals Security Act. And I know how that sounds. It sounds like paperwork, like bureaucracy, like another boring governmental memo that means nothing to your daily life. That's exactly the trap. Because the real power of modern control is not in the dramatic announcements. It's in the quiet language that rewires the system without asking permission. Buried in Section 3 of this order is a phrase so small, so deceptively bland, that most people will miss it completely. But these words are the reason the global banking system just lost its safety net. The phrase is Strategic Monetary Reserve Metal. 4 words. And those 4 words just changed what silver is in the eyes of the United States government. For the first time in over half a century, silver has been officially pulled out of the category of industrial commodity and reclassified as a monetary metal. That isn't symbolism, that isn't semantics, that is a legal detonation. Because the system built after 1971, after the gold window closed, was built on a lie so powerful it became invisible. The lie was that gold and silver are just rocks, inputs, materials, no different from copper, aluminum, or zinc. The lie allowed unlimited currency creation, unlimited debt expansion, unlimited financial engineering. And the lie allowed the price of monetary metals to be suppressed while the purchasing power of the public was quietly drained, year after year, through inflation disguised as normal life. But today, the United States government took that lie and snapped it in half. And then the order goes further. It doesn't just recognize silver. It activates dormant provisions tied to older monetary framework rules, including the requirement for the Treasury to maintain a strategic silver reserve equal to 18 months of domestic industrial consumption. This is the part where the math stops being theory and becomes a weapon. Treasury holdings, as reported, sit around 22 million ounces, but the requirement for 18 months of industrial demand is closer to 180 million ounces. That means the U.S. government has just created a legal mandate to acquire approximately 158 million ounces of physical silver. Not paper exposure, not a synthetic claim, physical metal. And they have to do it whether the price is $50, $200, or $1,000. That's not a purchase plan. That is a forced bid of historic size entering a market that was already strained to the edge. Now let us talk about the part of this story that Wall Street never wanted you to look at too closely. The part I've warned about for years. The part I call the death bag. The concentrated short position held by major banks in the futures market. The position that exists like a loaded gun pointed at the heart of the system. According to the most recent bank participation data, the major players hold a combined net short position around 215 million ounces of silver. And that number sounds abstract until you compare it to the one number that makes this whole scheme impossible. The total registered inventory available for delivery in COMEX warehouses was sitting around 18.4 million ounces. That means the system is short over 11 times more silver than exists for immediate delivery. It's like selling a house to 11 different people and praying none of them show up with keys on the same day. Under the old rules, they survived by using the escape hatch, cash settlement. When delivery time came, instead of handing over the metal, they paid the difference in dollars, rolled the contract forward, and kept the illusion alive. They turned a physical market into a paper market, and for decades it worked because nobody forced the truth into the open. But Section 7 of this new executive order is the blade that cuts the rope. It eliminates cash settlement for any contract connected to strategic reserve acquisition. The message isn't subtle: physical delivery or criminal penalties. No exceptions, no extensions, 90 days. That's not a market adjustment. That's an ultimatum. And it is mathematically impossible to satisfy. Do you understand what that means? The largest short squeeze in financial history didn't just become possible. It became inevitable, not because of rumor, not because of hype, but because the rules of the game just changed in a way that turns a hidden weakness into a fatal wound. And we're already watching the system twitch. Within minutes of the signature, silver began moving like something had broken loose. Asian markets reacted first, London followed. Circuit breakers started becoming a real conversation. And when a major exchange pauses to evaluate conditions, that's not stability. That's panic wearing a suit. That is the moment the machine realizes it is no longer in control of the pressure building inside it. Before we go deeper, if you want to stay ahead of moments like this, moments that the mainstream explains only after it's too late, take a second to like this video and subscribe to Money and Empires. Because what's happening right now isn't a one-day story. It's a rolling event. And if you're watching this, you're already ahead of most people who will only understand it when the consequences hit their jobs, their banks, and their savings. Now look at the second layer of fear here. When the death bag detonates, it doesn't just destroy bank balance sheets. It triggers margin calls across every linked derivative. It forces emergency liquidity. It forces silent bailouts. And the moment the Federal Reserve starts building special facilities, you're not watching a normal market function. You're watching damage control. Because the system is designed to survive volatility when the rules remain predictable. But when the rules change overnight, volatility becomes structural failure. And this morning, the rules changed. This is where the story turns from a metal market story into a banking crisis story. Because banks don't collapse from losing money on one trade. Banks collapse when the trade is so large, so leveraged, and so interconnected that the loss becomes an existential threat. Imagine a position built over years, quietly expanded because it always worked before. Imagine the confidence that comes from decades of, we can always cash settle, we can always roll, we can always manage the optics. And then imagine waking up to a legal reality where you can't, where the escape hatch is welded shut, where delivery is no longer optional, where the metal is now part of national security. That is what happened. Silver didn't just move in price, silver moved in status. And when something becomes strategic, governments stop negotiating. They start demanding. Within hours of the order, we began seeing the first visible cracks. Major banks started issuing carefully worded statements that sound calm but read like panic if you know what to look for. Trading suspensions, temporary halts, review of exposure, emergency meetings called with no clear public reason. And then, the most telling signal of all, an emergency liquidity facility announced specifically for precious metals margin calls. When you hear a number like $94 billion attached to the phrase margin calls, you're supposed to feel reassured. Or you're supposed to think they've got it handled. But the real message is the opposite. They don't build emergency facilities in a few hours unless something has already gone catastrophically wrong. Because the real derivative exposure linked to silver isn't measured in a few billion. It lives in the shadows of swaps, options, forwards, and structured products stacked on top of each other like dry wood in a forest that hasn't seen rain in years. The moment silver begins moving violently upward, every short, every hedge, every synthetic claim starts demanding collateral. Not next month, not next quarter, now. And the thing about collateral is it doesn't care about your reputation. It doesn't care about your brand. It doesn't care that you're too big to fail. Collateral is binary. You either have it or you don't. And when you don't, you start selling other assets to raise it. That's how silver becomes a trigger for a broader market liquidation. That's how one market becomes the match that lights the whole room. But there's another factor that makes this far more dangerous than 2008. In 2008, the crisis was buried in complexity and bought time through confusion. Today, the crisis is hitting a world that is already exhausted. Rates have been high, debt is suffocating, trust is fragile. People are watching their cost of living climb while being told everything is fine. And now, one executive order has introduced a new reality. The United States is openly treating silver as a monetary security asset again. That is not a minor policy shift. That is a signal to every central bank, every sovereign fund, and every industrial power on earth that the old monetary story is being rewritten. And when the story changes, the rush begins. Because nobody wants to be the last buyer in a market where physical supply is limited and legal demand is mandatory. Nobody wants to be the institution that explains why it didn't act when the writing was on the wall. The moment the U.S. declares a strategic reserve requirement, it effectively broadcasts a message. We are entering a scarcity era, and we intend to secure what we can. Every other nation hears that and asks one question. If they're buying, what do they know that we don't? Now we arrive at the part that terrifies banks more than price. The legal detonation. Section 12 of the order establishes a presidential silver commission with authority to investigate and prosecute artificial price suppression, subpoena power, asset seizure authority, personal criminal liability. That phrase, personal criminal liability, is not a footnote. It's a nightmare. Because the old world of financial misconduct was a world where penalties were paid by the institution, and the individuals who made the decisions walked away richer than ever. The new world implied by this order is one where people go to prison. And when that becomes real, the psychology inside these institutions changes overnight. Think about what happens when mid-level traders, compliance officers, and internal risk analysts realize the company is going to blame them to save itself. The moment they believe the ship is sinking, they stop protecting the captain. They start collecting evidence. They start cutting deals. They start telling investigators exactly how the suppression mechanism worked, who signed off on it, who approved the rollovers, who authorized the settlement tricks, who maintained the illusion. The death bag doesn't just explode financially, it explodes socially, it explodes politically, it explodes into a chain reaction of betrayal and self-preservation, and that's when everything accelerates. This is why the move toward 4 digits isn't fantasy, it's structure. Silver has been living under a distorted ratio for decades, priced as if it were abundant, priced as if it were disposable, priced as if it were just another metal. But history doesn't support that distortion. Throughout much of recorded civilization, the gold to silver ratio lived between 8 to 1 and 16 to 1. The modern ratio before this event sat far above that, like a glaring anomaly. And even those historical ratios assumed a functioning market with adequate supply. But we are not in a functioning market anymore. We are in a market where governments have made silver strategic, where industrial demand remains relentless, and where paper claims vastly exceed deliverable reality. Above-ground inventories are not infinite. They are not growing. They are being consumed. Silver is not just jewelry. It's electronics, solar, medical applications, defense systems, infrastructure. It's a material embedded in the backbone of modern life. And unlike gold, silver is often used in ways that don't come back. It disappears into products and landfills and tiny components spread across the planet. So when demand becomes forced and supply becomes constrained, the price doesn't rise politely. It jumps. It gaps. It becomes whatever number is required to ration what's left. And here is the question that should sit in your mind like a weight. If silver is being reclassified as monetary again, if banks are being cornered into a delivery crisis, if governments are moving to secure reserves, and if legal enforcement is about to turn decades of accepted practice into criminal evidence, then what else have we been trained to ignore? What other commodities are actually monetary instruments wearing a disguise? What other markets are sitting on a death bag of their own, waiting for one rule change to reveal the truth? I want you to answer this in the comments, honestly and deeply. If the system has been able to suppress something as fundamental as monetary metals for decades, what makes you think it can't do the same thing to your savings, your wages, your retirement, or the value of your time? Where do you think the next fracture will appear when this one fully breaks open? So now we have to bring this home. Not as hype, not as fear, as reality. Because moments like this are when people make the mistake of thinking the decision is simple. Buy, sell, hold, panic, chase, flee. But the truth is bigger. What's happening is a shift in monetary gravity. The post-1971 world survived because confidence held. Because people believed dollars were stable enough, banks were safe enough, and the system was controlled enough. That confidence is what gave paper claims their power. But the moment governments themselves begin pulling metals back into monetary status, the message is unmistakable. Confidence is no longer enough. Tangible reserves matter again. And once that happens, everything that was built on infinite leverage starts shaking. The paper-silver market, the synthetic ocean of contracts, claims, and derivatives, can only exist as long as nobody demands reality all at once. But strategic acquisition is reality. Legal mandates are reality. Criminal enforcement is reality. Physical delivery is reality. And when reality collides with leverage, leverage loses. It always does. That's the story of every crisis ever written. The only difference is the scale and the speed. Over the next days, the world won't describe this honestly. They'll call it volatility. They'll call it a disorderly market. They'll call it speculative frenzy. They will use every softer word available because the truth is too dangerous to say out loud. A core mechanism of price control has failed. A multi-decade suppression structure is being confronted by law, by physics, and by scarcity. And when something like that breaks, it doesn't repair itself with a press release. If you already hold physical silver, understand what you actually own, not a trade, not a chart, not a number on a screen. You hold an asset that is being dragged back into the category of money by force of policy. That doesn't mean there won't be violent moves, whiplash, and chaos. There will be. But chaos is what happens when a lie collapses. And if you don't hold it, then the most important thing you can do is not panic buy based on adrenaline. The most important thing you can do is to think clearly, to remove emotion, and to understand the difference between paper exposure and physical reality. This is not financial advice. This is a warning about how fast windows close when governments step into a market and declare it strategic. Because the real tragedy of wealth transfers is that they don't feel like opportunities while they happening. They feel like a confusion. They feel like disbelief. People wait for confirmation. People wait for the news anchor to explain it in a calm voice. People wait for permission to believe what their eyes are already showing them. But by the time permission arrives, the move has already happened. The door has already shut. The metal is already gone. The rules are already rewritten, and the only thing left is regret. This is why I called it a reset. Because a reset isn't a smooth transition. A reset is a violent repricing. It's a redefinition of what is real. It's the moment the system admits through action that the story it told you was incomplete. And today, at 11:43 a.m., that admission was signed into law. The death bag detonated, the paper illusion began to crack, and the world stepped into a new monetary era without even realizing the ground shifted beneath its feet. If this video opened your eyes, share it with someone you care about, because the people you love deserve the chance to think clearly before the noise overwhelms them. And stay close to this channel, because as the next domino falls, we're going to document it the way the mainstream won't, calmly, relentlessly, with the numbers, the incentives, and the truth. Because in a world where money itself is being rewritten, the most valuable asset you can own is not silver, it's awareness.